so making the last hour of trade extremely crucial to track. But on the sidelines of the third India Forum for Jefferies, Prashant caught up with Mahesh Nandurkar and started asking him about his views on the FII interest in India, especially in light of the recent purchases that they've been making. Let's hear that out.
We have more than 200 overseas investors, and that actually makes it the largest ever conference by any investment bank in terms of the number of foreign investor participating. At the same time, we also have 100 plus corporates as well, and very senior level representation from the chairman and the founder level, and strong representation from the government ministers and other industry experts as well. So the feedback that we're getting from interacting with the investors is that, I mean, just the sheer numbers first of all tell you that there is a lot of interest, and we are seeing interest coming into India not just from the traditional India dedicated funds or emerging market fund managers, but also global mandates as well. But clearly what, while the interest is at an extremely high level, at the same time there are some concerns around the valuation. So nobody denies the fact that the economic story, the corporate earnings growth story is looking very strong, and very strong on an absolute basis, very strong on a relative basis as well, because especially now with the expected slowdown in the US economy, the differential growth for India's GDP, the differential growth for Indian corporate sector EPS growth is looking even better. Okay. The key question is whether market is already factoring that in. And what has happened is, with a big surge of domestic liquidity, the foreign investors have been looking out for an opportunity to invest, and that opportunity has been denied to them so far.
Do they feel a little left out?
I think they do, because what has also happened is that the number of stocks in the benchmark, if you look at MSCI India, which is the very common benchmark followed by many foreign investors, 5 years ago we had about 75, 78 stocks. Today that number is more than 150, which means about 70 stocks have got added into the benchmark. These are all new companies across infrastructure, manufacturing, digital economy, and so on. And many of these companies and the sectors themselves in many cases are not well understood by many of the foreign investors. So, I mean, on one hand, you had an issue of valuations going up because of the strong domestic liquidity, and on the other hand, inclusion of several new stocks into the benchmark, which have actually outperformed the benchmark, where the foreign investors did not have enough familiarity with the sectors, with the company management, with the style of working, etc. So that has prevented them from taking active positions in many of these names. So yes, to that extent there is that feeling of missing out.
And it kind of ties in with the point which I was talking to Chris earlier, and he was saying that if people who are foreigners who are very familiar with India, they are still okay with what's going on and the kind of surge we're seeing, but generalist FIIs at the margin who are not very familiar, valuations and what's been happening is a bit more of an issue for them. So they're staying away. I think you're echoing that in that sense, right?
True, absolutely. I think one of the biggest change which has happened in the Indian economy is the turnaround of the investment cycle. So the fixed capital formation as a share of GDP has been consistently falling from 2010 down to 2020. And at that time, a very narrow set of high quality stocks did exceedingly well. And many investors actually did very well by being positioned in those narrow set of very high quality stocks, and the multiples for many of the stocks went through the roof. But the turnaround in the investment cycle, which basically talks about the improvement in the risk appetite in the Indian economy, not in the markets, the Indian economy. The risk appetite in the Indian economy has gone up quite a lot over the last 2-3 years, with more investments in infrastructure and manufacturing, in real estate, in power, and so on. Those have been neglected sectors. And so I think what we've been highlighting is exactly this big change of trend, which has a huge implication for sector and stock selection. And so my sense is that as more foreign investors take into their stride what has changed in India or what is changing in India, I believe the leadership in terms of the sector and the stocks will be very different over the next 10 years as compared to the last 10 years. A point that I've been making for some time, but it still has long legs.
And they got to get familiar real quick, right? Because otherwise they get elbowed out very fast. Because
True.
this surge of domestic money leaves little room in that sense. So
Absolutely.
and that's been a problem, I guess, for a lot of locals as well,
Yeah.
local domestic institutional investors as well.
Yes.
Mahesh, so two things. What are they most excited about for large foreign investors? What is the worry, if there is one, that you picked up?
I think the single biggest worry is still on the valuation side, as we just discussed, and whether as I said, the good news is already factored in.
Okay.
But outside of that, there is also some worry about the recent sort of election mandates and what kind of impact that it has on the capex activities, the government's investment plans going forward. We've already seen some changes at the state government level in terms of the policy making, and we've seen that there has been more sort of social spending and
a lot of handouts across.
A lot of handouts, yeah. It's been happening. So there is that worry that whether the similar things can happen at the central government level as well, and then what kind of impact that it can have on this. I talked about this turnaround in the investment cycle, whether that gets stymied by that. But thankfully, we had a few very senior ministers, at the conference, and they clearly allayed, those concerns. But actually, I would go one step ahead and actually highlight that one of the biggest misconception, I would say, in the Indian market today is that it's the government spending which is driving capex, and the private sector is lagging behind. Actually, that's a big misconception, in my view, because barring just one or two sectors like refining and petrochemicals, all other sectors are already seeing heavy investment from the private sector, be it steel or cement or infrastructure sectors like power and like telecom and airports and seaports and so on. And if you look at even the hard macro data, that shows you that like last year, the private corporate capex growth was up 18%. Household capex growth, which is in housing sector, which is real estate, was also up 18 to 20%. That's already there. Also, more bottom-up data like the ones reported by RBI recently, wherein they have taken together the private projects approved by banks for funding. They have not, the loan disbursals haven't happened as yet.
Sure.
The loans approved. And if you look at that trend, it already shows a 20% CAGR between FY19. I'm not talking FY20 because that was a low base.
Right.
If you look at the pre-COVID year, from there also it has grown 20%. So I think the common perception that private sector spending is lagging and therefore everything depends on the government, and if they slow down, what happens? I think that sort of conception.
In that sense, the fire has been lit, the spark is there, and it's going to be self-sustaining cycle.
Absolutely.
And
Absolutely.
perhaps will last for some time, right?
Yeah, so these cycles are usually 8 to 10 year cycles.
Right.
So broadly speaking, I say that 2000 to 2010 was an up cycle, 2010 to 20 was a down cycle, 21 was the turnaround. And I think, if you just go by the sheer history, and I'm not going by sheer history, there are other numbers as well,
Sure.
But I think this cycle should last till 2030, if not longer.
Okay. So, sectorally speaking, you were very bullish on real estate as a space, capital goods, industrials, etc. for the last many years. They've done very well.
Yeah.
But you've turned a little bit now, right? A little more. Is it just tactically turning a little cautious, or is it a more fundamental change in view?
Yeah, no,
because stocks have run up quite a bit. Go on.
Yeah, stocks have run up. So yeah, this shift is a bit more tactical. So as I mentioned, these cycles are long, and we are somewhere in the initial or maybe the mid stages of cycle in some of these sectors, if you look at it. So I still a firm believer that the real estate cycle, the infra, the capex, the manufacturing cycle will go until 2030, if not longer. Why I'm saying if not longer, because this time the regulators have also are also acting, the government sort of policies are also acting in a very prudent manner. They're actually learning from the mistakes that we did in the previous cycle.
Sure.
Ideally, the goal of the policymakers is to avoid this boom-bust cycle. So we have a a sustained but a longer term upcycle. So yeah, so to answer your question, still very, very optimistic on the real estate and the infra capex cycle. But at some of the stock level, I believe given the huge surge of domestic liquidity has taken the valuations in some of these stocks or some of these sectors to a higher level. And I'm not just commenting on the valuations, actually I'm just commenting on the quantum of the flows that are coming in. And while I've been a big bull on this whole financialization of savings and the equity culture emergence in the Indian households, but I think some of the numbers have gone up in a big way, and I think maybe to an extent gone to a level which I feel are unsustainably high from the flows perspective. So therefore we have taken some money off the table on some of these infra capex real estate names. But as I said, it's a tactical view. The fundamental view still remains bullish from a long-term perspective.
So Jefferies is not altering its call, still remains quite favorably disposed towards capex plays and real estate among some of their preferred sectors. We'll take a break on that note, come back on the other side, and of course all the latest buzz from